you mentioned Telstra and the banks. We have none of the big four banks, and we do not have Telstra in the fund. So just to comment on those quickly, the banks, we still think they have a lot of pressure in terms of their dividends and earnings growth going forward. So we think that they just do not have enough security to be considered defensive equities. Telstra is in a much better position than it's been in terms of where that industry is going, but we just still want to see that play out. Another sector I think is worth people thinking about is REITs. That's typically a very defensive sector, but we think now we've had almost 10 years of cap rate compression. I think that's something that people just should really pause and think about. How much lower can cap rates go? And then when you look at the different subcomponents, retail REITs, for example, online is really starting to become a material part of that sector, and the impact of that structural shift is starting to show up really in those businesses, and that may surprise people when that happens. And then another just overall industry comment on REITs, the payout ratios have crept up over time. So we're now over a 90% payout of both earnings and FFO for REITs, which is at the higher end of historical ranges. And just I think people should question how much dividend growth they're going to get out of those in the future. So let me give you something that's topical in terms of an investor day of the company. So Computershare, that's a company with global operations, shared registry, employee share plans, and mortgage servicing. They've had an announcement very recently that their FY20 earnings are probably going to be a bit impacted by the market. It's been a bit, share price has been a little bit weak on the back of it. We actually think that as a total business, that is far more defensive and robust than the market perhaps appreciates. We invested in that company in about 2015. Just to kind of paint a bit of context for you, at that time, the dividend yield was about 3%, and the company really wasn't showing any organic growth. So you might look at that and think, 3% is not a great yield, no organic growth, what's the attraction? The dividend was more than twice cash covered, so there was a lot of free cash flow, and the management had a great record of both reducing costs and investing in new growth options. And that's exactly what they did. So we were confident that they could take costs out near term to keep that cash flow, and they have invested that in new businesses. So we think that over the next few years, starting from our 2015 point, the dividend stream we're going to receive, while a relatively low 3%, will grow at a low double-digit rate over about 5 or 6 years because of that successful deployment of capital. So that would be an example of something that I'd say is not a typical defensive type stock in most people's eyes. Because of the behaviour of management, it really does add to its defensive characteristics.